Morning.
Good morning.
Good morning.
I don't know what's going on with this Zoom, man. It's giving me all kinds of fits.
What do you mean? What is it doing?
Well, for one, it wouldn't let you in the room. I guess it was a different link. But I update on it, and even it corrupted a file. It corrupted yesterday's file somehow.
Oh no.
I think I'm gonna have to start trying to record this to the cloud until I figure out what's going on. But anywho, today is part 3 on Wychoff. Now that I got the computer charger back, we can finalize this Wychoff discussion. We've talked about order blocks, we talked about imbalances, and for the last 2 weeks, we talked about Wychoff. Now, the important thing or the takeaway here with Wychoff is Wychoff is not used for, I guess, directional analysis alone, right? I mean, it is used to figure out if it's the market is going to go up or down, if you have a distribution or accumulation, but you're not using it alone, right? You're not just looking and saying, hey, Wychoff is playing out, the market is going this direction. We should already know or have an understanding of what direction the market is going based on the higher time frame analysis, right? Wychoff will help you understand if there's a distribution or accumulation or redistribution or reaccumulation during the move, and it'll help you with finding entries to your trades. So let me pull this video up.
On your keypad.
General, so what's that? Somebody just coming in. All right, I'm going to play this video. It's about 40 minutes, and then we'll wrap it up. If you haven't watched part 1 and part 2, I would highly recommend you to do so to get a much better understanding of these schematics. Understand that this 3-part series is an introductory series to Wychoff, but it's still a good idea for you to watch all of them. I will make sure to link the other 2 videos down in the description below as well. So let's go ahead and jump straight into it. First things first, same as accumulation and distribution schematics, there are many different schematics for reaccumulation and redistribution, but in this video, I have drawn maybe a couple of schematics, and I'm going to be specifically talking about them, simply because in my opinion, these couple schematics are the more important ones and are the more common ones that you will actually see in the market. The other 2 schematics or 3 schematics for redistribution and reaccumulation, it is in a way just derived from these couple different schematics. So let's start off with reaccumulation. I've drawn these schematics just to kind of make it a little bit easier to see, and I've just drawn some of the more important parts. So if you have other reaccumulation schematics, you will see that on other schematics there's a little bit more going on in the general reaccumulation schematic. I haven't even put, for example, the last points of support and the test and all of these different things in this specific picture, just because I want you to get a better understanding of the core fundamental important points when it comes to reaccumulation. So what is reaccumulation in general? Previously, we spoke about accumulation and distribution. Generally, when the market drops, goes sideways and goes higher, that's what we expect it to be, an accumulation. Or when the market goes higher, starts to go sideways and drops, that's what we would call a distribution. Now, in some scenarios, you will see the market going higher, going sideways, but this will still continue to go higher. So imagine a distribution scenario, but instead of the markdown phase, you will actually end up having a markup phase, right? So that is in a way what a reaccumulation is. And since it's called reaccumulation, as you can imagine, in a way it has to happen after an accumulation phase. Now, sometimes traders get really confused because when they want to identify a reaccumulation scenario, they would get extremely busy trying to see if we did have a perfect accumulation before that. Generally speaking, if we have had a markup phase and gone sideways and continue to go higher, then that is reaccumulation in itself. For this initial markup phase to take place, we must have had some type of an accumulation earlier. As I've mentioned in the previous video, there is no need to overcomplicate these scenarios. A reaccumulation in terms of the market behavior is very similar to the accumulation. You will see it manipulate the lows, you will see it break structure to the upside, and in general, that's the region, that's the range in the market that the early buyers are being taken out, and the larger institutions are in a way accumulating their positions again, introducing more demand into the market. Now, a reaccumulation can very commonly be mistaken by a distribution, especially because within the first half of the reaccumulation range, it looks almost identical to the beginning stages of a distribution. This is the important point that I always mention, which is never be married to a directional bias. Because if you look at a range and you say to yourself, hey, this has definitely got to be a distribution range, and later on you will see that it starts to go higher and higher, then you have lost the trade because you've stayed married to that directional bias at the very beginning, thinking to yourself that this is our preliminary supply. That would be the buyer's climax coming down to the sign of weakness followed by the UT. And then you would expect this to come lower or maybe create another UTAD before coming lower. And before you know it, you will end up losing the trades because you've ignored what has happened within the second half. That's why I always mention within the Wychoff schematics, you have to be patient. You have to see what the market gives you, and you have to see if the information that you can read on the charts is indeed matching other confirmations as well. So looking at each and every single one of these points within a reaccumulation range, you can see how at the very beginning, it does indeed look very much like a distribution trading range. So we have the preliminary supply that we normally have within the distribution. After that, within a distribution, you have a buyer's climax. You have these maybe step-by-step move to the downside or one major move to the downside, which we mark it up as maybe the automatic reaction over here, some type of a secondary test up there, followed by the sign of weakness. Within a reaccumulation scenario, in terms of the markup, we just change that sign of weakness to shake out. So not much is different here. At the very beginning, it looks almost identical to a distribution trading range, especially oftentimes you will see this automatic reaction back up from that shakeout can be mistaken with an up thrust. This is the time that a lot of traders would actually mark this up as a UT. But again, we know that even if that is a distribution, that's not complete yet. We can't be looking at any trading scenarios until we have proof of distribution and we start to break structure to the downside. So even if you happen to identify a reaccumulation at the very beginning as a distribution, it doesn't matter. As long as you pay attention to what takes place after, you're good. In fact, a lot of the reaccumulation scenarios that we have identified at the very beginning, we thought it was a distribution. But in the journey of having patience and waiting for the proof of that distribution, we started to see that the market behavior started to change. We went from manipulating the highs and breaking structure to the downside to manipulating the lows and breaking structure to the upside. And that's more or less exactly what takes place within a reaccumulation scenario. Once we've formed this kind of first half of the reaccumulation, you can oftentimes see how we will continue to maybe create liquidity, whether it be in forms of the support and resistance lines, or even if it is lower time frame trend lines that we all know retail traders would be drawing on their charts, expecting this market to reject the trend lines and going higher. And before they know it, through this move to the downside, which we call spring within the reaccumulation, they are taken out. So I'm going to go through that one more time. At the beginning of a reaccumulation range, it does indeed look like a distribution with your preliminary supply, bias climax, sign of weakness, what we call that shakeout in a reaccumulation, and the automatic rally back up. Don't be too tough on this automatic rally back up, expecting it to always be above or below the bias climax. allow a little bit of a range. Sometimes it forms a little bit higher, sometimes a little bit lower. The entire point of this automatic rally back up is for it to, in a way, test the previous areas of supply to have some room to go lower and perhaps manipulate the previous lows. After we get this distribution-like scenario, from there you tend to see more manipulation of the lows and a move higher than the other way around. And with the spring action, it's oftentimes will be given away that you are looking at a reaccumulation rather than a distribution scenario. Yet again, don't be too invested in the schematic. What I've drawn over here is not exactly what you have to see on your charts. What I'm trying to say is within that range from the automatic rally down to that spring, sometimes the market will create random highs and lows. Oftentimes it will end up testing the previous areas of supply or demand, just creating a range, creating an area of liquidity for it to later on be manipulated through that spring. Remember that a break of structure is always necessary for any and every Wychoff schematics to be confirmed. If you are not getting a break of structure in your desired direction, then at least at this stage, at the more beginner stages of learning about Wychoff, you most definitely should not trade it. Wait until you have confirmation that the market has moved away from your zone of reaccumulation higher to prove that, yes, indeed, that is a reaccumulation. And remember what we spoke about previously in regards to accumulation. Accumulation is a manipulation of the lows and a break of structure to the upside. And this is exactly the type of behavior that you will be able to observe within a reaccumulation range. Similar to accumulation schematic number 1 and number 2, you will sometimes be able to see a reaccumulation without that spring action. It would look something like this, where after forming these elements of distribution at the very beginning, where it kind of looks like a distribution, we don't really get that spring, which in a way manipulates the entire range to the downside. Spring, as mentioned in the previous video, is the lowest point within that accumulation that we would expect it to create before going higher. Sometimes in reaccumulation scenarios, that spring is non-existent, exactly the same as accumulation schematic number 2. These are a little bit more challenging to identify and trade, but the market behavior stays consistent even within these scenarios, where you are able to see within the range that gets created, you will tend to see manipulation of the lows and a break of structure to the upside. Sometimes people are extremely confused in terms of how do I identify the differences between a reaccumulation or a distribution. This is going to be a point that I will talk about a little bit later on, but if you want to stay safe against these uncertainties in a reaccumulation range, you can actually even wait for the market to in a way break outside of the range completely and then come back to trade it. So instead of taking into account these smaller breaks of structure to the upside within the range, you can wait, have patience until we start to break outside of the range completely. And that is where it gets confirmed that, okay, you're looking at a reaccumulation. But in live markets, it's going to be a different scenario, because obviously you will tend to see smaller accumulations and distributions within the range. That makes the analysis much easier and much clearer. So let's go ahead and jump on the actual charts and have a look at a couple reaccumulation scenarios. The first one I want to speak about is this Euro USD reaccumulation, which we already have a video about this posted as well, titled under Best Forex Strategy 2020, if you want to go ahead and watch that. I'm going to put this in replay mode and perhaps go to the hourly time frame just so we can see this a little bit easier. So let's have a look at it first from a distribution perspective, because that's exactly what we saw at the very beginning, with this looking like the preliminary supply, this being the buyer's climax all the way down to the sign of weakness and the move to the upside as your up thrust. So this at the very beginning, you can see that it did indeed look like a perfect distribution. What happened after, however, started to little by little give it away that potentially we are not actually looking at a distribution scenario. Even if you stayed married to that directional bias and you told yourself, okay, do you know what? I'm going to take some entries, for example, at maybe this area over here. This should be a 4-hour institutional candle, if I'm not mistaken. We can have a look at that very quickly. Yeah, so let's say you told yourself at this institutional candle, you were looking to take some trades. Even if you did, by the time you've seen this decline, this is where trade management would have to come into play, where you're either closing some of your positions or at least breaking even your trade. So trade management, again, is a very, very important part of this as well. So even if you are mistaken with whether you're looking at a distribution or reaccumulation, through trade management, you can manage your risk accordingly. So at the very beginning, we saw that as a distribution, but what happened after is what started to give it away, because the entire market behavior changed from manipulating the highs to taking the lows and reversing. So in a way, manipulating the lows and reversing. And it ended up forming this perfect reaccumulation scenario, this reaccumulation schematic from the buyer's climax. So that's the buyer's climax down to the shakeout, buyer's climax down to the shakeout, following the automatic rally back up. Now, this isn't the best automatic rally. It went a little bit higher than that buyer's climax, but it's still very valid. And that's indeed what we will take into account. Following that automatic rally, we had this continuous manipulation of the previous lows and a reversal almost straight away, manipulating the lows, creating liquidity within this range. You can see the zone of quote unquote support that's being created and how we're manipulating the support and reversing, manipulating the support. And through this move to the upside, this is where the reaccumulation got a little bit more confirmed. So again, understand that it would have been over here that we would have been able to see that, okay, yes, the reaccumulation has actually gotten a little bit more confirmed now. Potentially from a distribution, we have moved into a reaccumulation, or potentially we've identified the wrong range as a distribution, and this is a reaccumulation. In a lot of the reaccumulation schematics, you can see the term creek. Now, creek by definition is a line connecting the high points of that range. So if I go ahead and just put a line over here and connect the high points of this range, that's what you can call your creek. And once the market moves outside or above that creek, that's what we would call the jump across the creek, in a way confirming the accumulation. Instead of me looking at that in terms of creek, I would be just looking at that in terms of a break of structure. So instead of us needing to draw a line over here, what we can do is we can identify internal structure points, lower time frame accumulations and distributions, and simply taking trades based on those. Creek is just another way of looking at break of structure. So this is now the more complete reaccumulation markup from the buyer's climax to shakeout, automatic rally back up. And from that automatic rally, you can see even signs of a bearish trend being created, but it ended up manipulating the lows, reversing and breaking internal structure points to the upside. So up until here, we wouldn't still be extremely clear that this most definitely is a reaccumulation scenario. We can actually take the risk and enter based on other confirmations, which I will speak about a little bit later on. But if we want to be a little bit more careful with the trade, this is where we would have an idea that we can potentially be looking at this as a reaccumulation, but we want to see further confirmations. And it's what happens after, in my personal opinion, that would further confirm this reaccumulation. Remember what we spoke about, constant manipulation of the lows, whether that be in terms of support or a trend line. And what took place after is indeed a beautiful confirmation that yes, we are looking at a reaccumulation range rather than a distribution, because now this is an internal accumulation taking place within the same range, a lower time frame accumulation. This should be a lot easier and a lot more visible to see on the 15-minute time frame, but even here you can identify this as your selling climax, automatic reaction, secondary test, sign of strength. That's not really on the schematics, but that's our sign of strength to the upside, following the secondary test in phase B and the spring. And following that spring, we started to challenge multiple structure points to the upside, pulling back to mitigate some institutional candles on the higher time frames. And once we started to trend, then it's obvious that yes, we are looking at a reaccumulation range rather than a distribution range. And you can even see within this smaller time frame accumulation, the manipulation of the lows is something that is constant. You can see clear manipulation of these lows. And even later on, you can actually see how we have created this trend line. Let me delete all of this and draw the trend line again. You can even see how we've created this trend line and manipulated the trend line and moving higher after that. So there are many, many, many different points that you will be able to see manipulation of the lows if it is going to be a reaccumulation. It's just about paying close attention to the market, not staying married to your previous directional bias and allowing the market to tell you the story. So this is a nice reaccumulation scenario where we started off as a potential distribution, moving to manipulating the lows, forming, let's say, this creek, spring, break of minor structure points to the upside, creating lower time frame accumulations, which would confirm the previous reaccumulation and continuing to manipulate the previous lows, whether it be in forms of a trend line or equal lows, whether it be over there, or whether it be these equal lows, relative equal lows over here, just constant manipulation of the lows, and you would be able to see the move higher. Now, remember what was mentioned, a reaccumulation in a way has to happen after an accumulation phase, or at least after a markup phase. And that's exactly what we have. We've had a previous accumulation range, a markup phase, a reaccumulation, and the continuation. I want to look at one more scenario for reaccumulation as well. This is going to be GBP USD, and this time we are going to be looking at it from a perspective of a schematic number 2, where we didn't necessarily get that nice final spring to the downside to completely come lower than the entire range. So I'm just going to put this in replay mode again so we can look at it a little bit easier, and let me zoom into the hourly time frame as well. This is another potential reaccumulation that, again, at the very beginning, it could have been mistaken by distribution from the buyer's climax all the way down here to this shakeout, or people would have identified this as the buyer's climax, to this automatic reaction, maybe secondary test over here and the sign of weakness, following this up thrust and maybe waiting for up thrust after distribution to then sell it to the downside. I'm going to put a pause on this potential distribution and actually come back to it in a couple minutes. But from a reaccumulation perspective, you can see that we have the buyer's climax all the way down to that shakeout. So in a way, that move to the downside from the buyer's climax to the shakeout, and then seeing the automatic rally back up, again, looks like a distribution. So that's that beginner phase that looks like a distribution. Following that, instead of constantly manipulating the low of the range, we started to form another lower time frame accumulation within the same range, and you were able to see elements of manipulation of the lows within this range, whether, again, you're looking at it in terms of a trend line, or whether you're looking at it in terms of, let's say, more internal liquidity being created over here, where we have equal lows, manipulating the equal lows and then moving higher. And more than necessarily looking at it in this specific scenario in terms of manipulation of the lows, it was the smaller time frame accumulation within the same range that would make the entire reaccumulation more confirmed and more valid. I don't think I need to necessarily mark up this accumulation. I hope by now you can all identify them a little bit easier, but if I want to, this will be your seller's climax to sign of strength. This is areas of secondary tests in the market following a secondary test in phase B or spring, however you want to label it. In this case, it doesn't really matter, and breaks of minor structure to the upside or major structure points to the upside that got broken through this rally higher. So again, understand that in the reaccumulation range, in this range, we wouldn't be necessarily looking to snipe it down here. We would want to see confirmation that this is a reaccumulation. We have moved away from that zone, and this is indeed a lower time frame valid accumulation, and then we'll look for pullbacks to enter the trade. Funnily enough, once we started to move higher from that level, when we ended up coming back into the same levels, you were able to also see constant manipulation of the lows before we started to see a rally higher. How we are reaching below, even if it's a few pips, reaching below the previous lows and then reversing and going higher. I mentioned I'm going to look at this from a distribution perspective as well. So let me go ahead and get rid of these, and then we can have a look at this from a distribution perspective. So let's say buyer's climax to the sign of weakness, up thrust. And even if you did identify this as the up thrust after distribution, you can see that the break of structure that we had to the downside wasn't a major break of structure. These are minor structure points, and that wasn't the best looking break of structure. We very barely reached below that zone. I would want to see a little bit more defined break of structure. So even if you were looking at that as a potential distribution, you shouldn't have necessarily taken the trade once we created that, let's say, up thrust after distribution. You would have still waited for confirmation of bearish structure, and then once you started to see this move higher, then obviously you would have stopped taking any sell positions. This was also a very nice scenario for reaccumulation. We did have a good, I'm going to calculate it from here, from the top of that range, a good, 200-300 pip move away from that reaccumulation, which is nice to see. But this is, as I mentioned, an example of the schematic number 2. Where we didn't necessarily get that final spring to manipulate the low of the entire range. We're going to now speak very briefly about redistribution. And the reason I'm not going to speak too much about redistribution is because if you understand reaccumulation, if you can just take reaccumulation and study it in great depth and understand it, then all you got to do for you to practice redistribution is come back to your charts. If you are trading on TradingView, you can click down here right above where it says auto and click on invert scale. And it will literally flip your entire chart. And the reaccumulation that we were looking at for Euro USD is now an example of a redistribution. So as long as you understand reaccumulation, you also understand redistribution. I also have another video on redistribution where you can find it under the Wychoff introduction playlist on this channel. So I would encourage you to go and watch that if you want more information about redistribution. But let's speak about one major schematic for redistribution, Again, there are multiple different schematics for redistribution. However, this is the schematic that's most commonly seen. And also this is the schematic that's most commonly traded. So imagine everything I talked about in terms of reaccumulation, but now we're going to apply that to redistribution. So you can imagine for this to be a redistribution, we need to see the markdown phase or at least another distribution at the top of that range before we moved lower. And the same way in reaccumulation, the first half looks like a distribution. Within a redistribution, the first half will look like an accumulation, where people would identify this again as a preliminary support, selling climax to the automatic rally or that sign of strength back up. Again, this is the move that's in reaccumulation schematics. You can see this as a step-by-step move to the upside, following that secondary test in phase B, maybe expecting a spring before they buy it to the upside, or expecting some major structure break to the upside before they look to buy it. But paying closer attention to the actual market behavior, you will tend to see that within a redistribution scenario, liquidity is being created in the form of equal highs or trend lines or whatever it may be. Liquidity is being taken to the upside, so we are manipulating the highs and moving to the downside. Oftentimes within a redistribution range, you can see that the market will create a smaller bullish trend. And after the final manipulations to the upside, that minor bullish trend will completely break and turn into a bearish trend. This is a little bit more textbook in terms of actual structure points in the market. Characteristics of distribution should also be seen within a redistribution range, meaning oftentimes you will tend to see manipulation of the highs. Oftentimes you will tend to see even lower time frame distributions being formed within the same range to confirm that the larger players are introducing more supply into the market. The larger players are actually distributing this market again. And it's through these factors that we would be able to distinguish between an accumulation or a redistribution. Where are we manipulating and where are we breaking structure? So more than speaking about redistribution in this picture, I actually want to have a look at it on the actual charts. We're going to have a look at the AUD USD redistribution example. I'm going to put this in replay mode again, just to make it a little bit easier for us to be able to look at it and identify it. And we're going to have a look at this on the hourly time frame. We're going to look at this the same way we did for the reaccumulation. How in this case, even at the very beginning, you can see that maybe as your preliminary support, sellers climax to this automatic rally back up or this sign of strength, the secondary test in phase B. And in this case, this accumulation looks much nicer because we even got clear breaks of structure to the upside and this market moving higher and higher, where it most definitely would have enticed a lot of people to look to buy into AUD USD. However, paying close attention to what started to take place after within this range would have given it away that even if the larger players were looking at a potential accumulation at that range, they have probably changed their minds and they're probably looking at distribution. So again, it's very important to not be married to any directional bias and allowing the market to tell you what it's going to do rather than you expecting the market to go higher just because you have identified an accumulation. It's such an egotistical thing to tell the market what you expect to do. Hey, it's an accumulation, therefore it definitely is going to go higher. That means nothing. You have to go based on what you see. And in this specific picture, you can see the markups for the redistribution from this selling climax over here. And then we have an automatic rally back up from the selling climax. And that's our automatic rally back up. We just didn't put that automatic rally over there. Or you can even identify this as your automatic rally back up from that seller's climax. And following that automatic rally, you get this test in phase B. And following that, you tend to see UT or UTAD, your upthrust or upthrust after distribution. This is the giveaway for redistribution. While we are forming that upthrust and upthrust after distribution, you tend to see lower time frame bullish structure that's being broken to the downside and turning into this very textbook bearish structure. And not only that, you would also be able to see smaller scale distributions happening within the same range, which even if it doesn't make you certain that's a redistribution and you should sell it, at least it should make you careful about the initial accumulation. So maybe you just want to take a step out of the market for that specific day. In this case, that's exactly what took place. I've just put this general zone over here as the creek. I'm just going to take it off so we can have a look at the smaller distribution a little bit easier. Both of these pictures are lower time frame distributions that have now taken place within the same range. You can identify this as your preliminary supply, buyer's climax, the sign of weakness, secondary test within the range, upthrust and upthrust after distribution. proof of distribution, or minor proof in this case of distribution, with that minor break of structure to the downside. Once we started to break below this entire range, that's when the distribution would have been much more confirmed. But not only that, this is the smaller time frame or lower time frame bullish market that was created. And once this distribution was completed forming, that turned into a bearish trend. Very textbook market structure over here. And as if that wasn't enough, from there we moved to create another lower time frame distribution, which we can have a look at that on the 15-minute time frame, where you can see again signs of distribution happening within this range. However you want to identify this: preliminary supply, bias climax, the sign of weakness. You can see these as your secondary tests, this as the up thrust, breaks of the minor structure to the downside, a little bit of indecision in the market. I'm going to, for now, describe this as indecision, but eventually you would have been able to see the confirmation of that distribution through the move to the downside that we had. You might be wondering, okay, if I wanted to wait this long, I would have been missing out on this trade. That's false. We need to get that idea out of our head that we got to trade the schematic whenever we see it there, and then be a little bit more patient with it. So even if you're identifying the, let's say, incorrect schematics, looking at this as a potential accumulation, through your patience, you would have been able to see otherwise after how we created a distribution trading range after that, how we moved from this bullish trend to the bearish trend, and we also created lower time frame distributions. I'm really liking this new trading view update, by the way. Highlighter, yep, I like it. Good job, trading view. But from there on, that would have been the confirmation of the distribution. As I mentioned previously, you could wait until the market breaks out of the range completely, for example, over here, and then look for some trades to take over here upon some of the pullback based on some other institutional concepts, or based on whatever other concepts that you want to trade. But this is now a textbook example of a redistribution. As I mentioned, I have another video on redistribution, which I will also link in the description down below if you want to know a little bit more for redistribution. But now I want to speak a little bit more about how to tell the difference between an accumulation and redistribution, or between a distribution and a reaccumulation. First point is very obvious: practice. Get your eyes used to seeing them, back test them, forward test them. Spend time analyzing different markets on different time frames. Save your analysis, come back to it in a few days. Go back to demo account if you're worried. Don't expect these concepts to very quickly elevate your trading game. Put in the necessary time, and you will be able to learn these schematics in your own way and apply them to your chart based on your specific set of rules. Now, practice to one side. If you continuously ask yourself where in the market is being manipulated and where are we breaking structure, this should answer majority of your questions, whether it's an accumulation or redistribution, or whether it's a distribution or reaccumulation. Which way are we grabbing liquidity? And after the manipulations, which way are we breaking structure? Remember that I would want to see some type of a break of structure, or some type of a proof that moves away from the area of manipulation straight after it manipulates. So the idea behind it is, when we manipulate certain highs or lows, I'm going to go back to the Eurusd example in this case. When we are manipulating, let's say, certain highs or certain lows, for example, in this specific scenario, as the market is manipulating these lows, it's in a way tapping into previous zones of demand. All of this down here, which is people's stop losses or different type of orders being kept in this range in a way, this can actually be looked at as a zone of demand. So if we move away from that level, if we have a decent move away, and if especially that move away is breaking structure, then that is going to confirm that as a zone of demand. So I want to see what happens almost straight after we manipulate. Are we having a major move? Is that proof that that's a zone of demand down there? So is that definitely a manipulation of the lows and then a break of structure? And then I'll go ahead and trade that accordingly. On top of market structure, what I've written there in terms of order flow, this is also another very important thing. Higher time frames need to agree with your bias. So if you are looking at a reaccumulation, there must be some type of a bullish order flow on the higher time frame. We must be moving higher and higher, and there must be some type of an objective for this to move higher. I'll speak about that in the next slide a little bit more, but think to yourself, where is the general order flow? Which way have we been moving? Have we been moving extremely bullish, and now all of a sudden you want to identify distribution and call the top of the market? If that's the case, you have to be more careful. Don't try and go against the major moves. Don't try and go against the major order flow and then be surprised that the trades are going the wrong way. Patience, yet another obvious point, but I scream this in every single video because it's important for traders to know. A lot of traders think they are patient and think they waited up for the trades. I think it's not important. You're either going to develop the patience or scratch your head in a few months thinking about how you lost 15, 20, 50,000 in these markets. So be patient. Get rid of your fear of missing out. If you want to tell the difference between accumulation and distribution, wait, see what is forming, see which way we are manipulating, see lower time frames, accumulation and distributions, if there are any forming in the same range, and see which direction out of that range we will completely move outside of. It's the patience that stops you from taking stupid trades and allows you to have a more clear directional bias. Stop having the fear of missing out. There's always a trade around the corner. In some of the reaccumulation scenarios, in fact, for the AUD CAD reaccumulation scenario, I think it was AUD CAD that resulted in something like a 1 to 130 risk to reward ratio. The patience for that was over a month. We had to wait over a month for that specific trade to come to fruition, if I'm not mistaken. But is it worth waiting that long and then catching an extremely high risk to reward ratio? Of course it is. An objective, I thought I was going to speak about this in the next slide. I will elaborate this a little bit more in the next slide. But generally, why do we need to accumulate or distribute? This is what I meant when I was talking about the higher time frame bias, because sometimes I would want to see what type of institutional candles are we trading into on the higher time frames, and perhaps on the lower time frames, then expect to see some type of an accumulation or distribution. Because now I have a higher time frame objective. There's a higher time frame institutional candle, for example, as long as it also agrees with the higher time frame structure. Then if I see accumulation or distribution on the lower time frames based on those higher time frame institutional candles, then obviously there is an objective for that specific accumulation or distribution, and the objective is consistent with the higher time frames. The market is always telling you the story from the higher time frames to the lower time frames, so try and read that story. Finally, some more important points to remember. Stop worrying about entries. I have so many people who ask me about where do you enter, where do you enter, where do you enter? It's thirst. That's the best word I can use to describe it, even if it hurts some of you. That is thirst. Stop worrying about entries. First, actually learn the schematics, learn to identify them, be good at identifying the schematics, look at the market, get your eyes used to seeing the schematics, learn the market behavior behind them, get consistent identifying these schematics, and get consistent seeing the market direction in the correct way, then worry about your entries. One of the major purposes of me doing these videos and of this channel in general is to help you think independently when it comes to these concepts. So stop trying to skip ahead, identify the schematics properly, learn about them properly, and if you think that you have put in enough time, then go to the playlist section of this channel, click on the high risk to reward trades and start to look at them one by one, and you will get an idea about how we also would use other concepts for entries. Also remember that we always have to see a validation of accumulation or distribution or reaccumulation or redistribution before we take a trade, which is that break of structure. That's what makes an accumulation or distribution valid. Again, people are extremely confused about what we mean by break of structure. Where is the structure point? For now, especially if it's the beginner stages, if you're looking at Wychoff, you can identify your trading range as your structure. And once we start to break outside of that, then boom, you have a break of structure. Simple as that. Don't trade Wychoff on its own, which I have mentioned this so many times. You cannot just open a chart and think to yourself, hey, that's a distribution on the 15-minute time frame. I'm going to trade based on it. Will it sometimes play out? Of course, but you always have to see what higher time frames are telling you. Remember what I spoke about the market always tells you a story. You have to see what the higher time frame structure is telling you. What's the higher time frame areas that we've manipulated? Then little by little zoom into the lower time frames, maybe identifying some type of an accumulation or distribution. And once you get a break of structure, then zoom into the lower time frames and try and perfect the trade and so on and so forth. So don't trade Wychoff on its own. Utilize other concepts that we have spoken about in this channel. And finally, patience, both in your learning and in your trade execution. You have to allow time for you to learn these concepts properly, and even more time for you to be able to apply them the correct way. In some of the previous videos, I have spoken about hundreds of hours being invested into these concepts, and I stand by that. Invest at least a couple hundred hours for you to be able to learn properly about all of these different schematics and all of these different concepts. Now, this brings our Wychoff introduction series to a conclusion. I was unsure whether or not there's going to be a part 4 to this introductory series, but as of right now, I'm not really looking to record any other video for this specific Wychoff introductory series. Maybe later on, we'll come back to it with a little bit more advanced Wychoff, break some more charts down in terms of what.
Alrighty. So that was the Wychoff series. You know, I want to touch up on a few things that he said, and you know, a few things that kind of stick out to me whenever I listen to his breakdown of Wychoff. Don't use Wychoff for directional bias, right? That's very important. You should have a directional bias from your higher time frame order blocks. That's where you get your directional bias from. Your Wychoff will allow you to hone in on maybe some entries, or it'll help you understand, you know, when the market is pivoting, or whether, hey man, you know, it's redistributing here, it'll give me an entry, or it's reaccumulating here, it'll give me an entry, right? So he also said that he dedicated about 400 hours to this. You know, people will glaze that over that fact. When you start studying the markets, it's important for everybody to understand that this is a long-term situation, right? This is not a quick fix to a financial issue that you may be having. This is not a elementary book that we're reading, and you'll understand a great story, you know, at the end of the 30-minute process. Learning how to trade requires extreme dedication, and it requires time, right? Time and experience. You're going to see the same thing over and over. You're going to see the same pairs, and they're going to move back and forth, you know, through the same price ranges over and over, right? And through time and experience, you're going to gain a better understanding of what you're looking at. It's kind of like learning the English language, right? For those of you who have children, you know, at some point, you know, you had your child and they couldn't understand a damn thing you were saying, right? And then they understood what you were saying, but they couldn't talk back to you. So they cry to manipulate you. At some point, they could start saying a word, whether it's daddy or mommy or eat, fat, whatever. And then they could put 2 or 3 words together. You know, at some point, they started talking, even though they didn't speak proper English. You know, their sentence structure may have been raggedy. Maybe they used words inappropriately. Maybe they didn't have subject-verb agreement. You know, some people never learn subject-verb agreement. That's another story, but trading is the same way. You know, when you start off, you don't understand it. And then you have somebody sitting in front of you telling you, you know, telling you things like I'm telling you now, or helping you, pointing you in the right direction. It's up to you if you go further than this discussion. It's up to you if you crack open your own YouTube, because your understanding of what I'm saying may be totally different than the next person's understanding of what I'm saying, right? I can introduce you to these concepts, but you may never understand them the way I understand them. And on the flip side of that coin, I may introduce you to these concepts, and you might go off and learn them at a level that I haven't achieved yet. You know, and that's really my desire, because I don't want to be the smartest person in the room, or I don't want my understanding to be the only understanding. What I would really like is somebody to take this and run with it, and then they're the ones giving class, like Alicia, you know, like Brianna, you know, like Will. because those are the people that pour back, into you, So it's up to you guys whether you take these concepts, right, and these rudimentary introductions to the concepts, and you further develop your understanding. Okay, so we've completed the Wychoff series, but we really didn't discuss who Richard Wychoff was, or his vision. See, Richard Wychoff was an interesting guy, and he had great success in the market. But the way he broke down the markets, it still makes a lot of sense. He broke down the markets based on a fictitious character he called the Composite Man, right? And when you think about it, most trades, they'll wick past your stop loss, or they'll wick you out of the trade. Most of us who lose trades, we don't lose because we don't understand the direction. We lose because maybe our stop loss is too tight, right? How many times have you lost a trade where you wake up and you're out of the trade, but the trade is maybe 30 or 40 pips, 50, 100 pips in your direction? There's this theory called the Composite Man. And what Wychoff believed was that the big dollar traders have enough money to push you out of the trade, and what that means is if they know that they want to take the price of a stock, because he traded stocks, not Forex. But if a guy who had $1 billion wanted to buy Coca-Cola company, and he wanted to take the stock higher, all he would have had to do is buy Coca-Cola or sell Coca-Cola to drive the price down. And the people who don't have as much money would have been scared, right? The price falling and you seeing your money turn red would be enough to get you out of that stock. You sell your shares of Coca-Cola. And when you share your shares of Coca-Cola, he has infinite amounts of money, so he buys the shares that you get rid of. And once he buys the shares, he just starts buying up all the shares. And now he's shaking you out of your position. You were in a good position to make money. But because the price started falling, you would get out. Same with your stop loss. Because the stop loss is, because the price is going the opposite direction and you see your account in the red, you get out. Meanwhile, once enough people get out, they take it and they buy the price back up in the opposite direction, and they make a lot of money. And you watch the price go the direction you thought it was going to go, and you miss out on your money. So I understand we all have limits and we all have an account size, and sometimes we can't maintain the level of drawdown that's required to take the trade higher or lower. But most of the time, the problem is not our account size. The problem is our lot size, right? We over leverage. We have too large of a lot size. That's why traders who trade the percentage are oftentimes the most successful traders, right? If you put 1% on a trade, then 1% of your account can sustain most drawdowns if you have the directional bias correct. So when you're out here trading, please keep in mind that you're not trading against dummies, right? And you're not trading against inexperienced people like ourselves, right? You're trading against college educated, oftentimes 5, 10, 15-year experience people who understand how to scare you out of a position, who understand how to liquidate you before they take the price to where they're going to. All right, if you trade with that in mind, you will be a lot more patient and hopefully a lot more successful, right? Because your understanding of the market and the directional bias that the order blocks give you is not going to be wrong, right? The order blocks are going to tell you where the market is going. They're not going to lie to you. Your eyes will lie to you. Your position size will lie to you. And that's what you have to get under control, right? You have to learn as a trader to manage your emotions, right? You have to learn as a trader to limit your lot sizes. You have to have an understanding that you're not getting rich with this trade. You're not getting rich today, tomorrow, next week, next month, or next year, right? You can get rich, but you have to understand this is the long game. This is not a short game. It's not a get rich quick, you know. If you just focus on winning the next trade, you'll do fine, right? Next thing you know, you'll put your string together, 7 or 8 wins to 2 losses. And if you can have that ratio and you can maintain your discipline, you'll have more money than you know what to do with. But you have to resign to the fact that this is not a get rich quick scheme. This isn't Vegas. This isn't the lotto, right? This is your job. You know, most of us understand we have to be at our job for the rest of our lives, right? So this is your new job. That's all. That's it. You know, I mean, it allows you more freedom, but damn, you got to come to work. Like you have to come to the markets to get your money. And just like I do, you know, if I don't show up and place trades, I'm not going to get paid. I'm by no means rich, you know. I'm in a good situation. I make more than I made on my job, but this is my job. So if you approach your trades in that manner, you know, where you're coming to work, you know, however often you want to come to work, but when you come to work, you have to focus and you have to actually work. You know, you have to read your instructions. You have to set rules and abide by rules. Like most of us have rules of the job. You know, we can't go get on our cell phones at work. We can't go drink. We can't go smoke weed or whatever our drug of choice is. We can't curse out the boss. We can't strip and be naked. You know, any of the dumb stuff. So the same applies to this job, right? When you trade, you have to trade by those rules. You know, you should only risk, you know, 1% of your account. You know, they say 1 to 3, but man, 1% is plenty. You're going to make a lot of money risking 1%. But just have the understanding that this is a job. This is your new job. And you don't have to work every day. You can work 3 days a week. You can work 1 day a week if you get it correct, you know. Set goals, man. If you make 5%, if you make 10%, you can make 4% per week. You know, if you go out there and tell a billionaire that you can make 4% a week, they'll give you all unlimited amount of money, right? 4% a week is huge. So just set goals. You know, once you start setting goals, you know, you can pick out your own trade ideas, be patient, enter the trade. You know, that's another thing that's a trigger word for me, because he say, man, don't talk to me about an entry. Don't talk to me about sniper entries. Sniper entries are a lie. Who cares? It's not about your entry. You can get I can get the worst entry and still out trade you, because there are several opportunities for re-entries, for accumulating your position size. You can add to your position size. So don't talk to me about an entry. I don't care. Get in the trade that's going your direction. Once you're in the trade, You can get all kinds of sniper entries. You can get a sniper entry on the 5 minute, the 15 minute, the 2 minute. There's all sorts of ways that you can get additional entries on your trades. So if you're a patient trader, you know, and you have an understanding of the market, you're going to do well for yourself as long as you abide by your rules. All right. I wanted to pull up Richard Wychoff's story, so you can understand what the Composite Man theory actually was. The theory. So if you're ever in a trade and it seems like the trade goes against you initially, it's because of the market makers they're paid to get you out of the trade. So prior to these smart money concepts, has anybody heard of Wychoff? Anybody?
I have, but I can't remember. I know I pulled up his story once, but I can't remember much of it. My brain don't work like it used to.
All right, you can do a simple Google search, right? And you can pull up Richard Wychoff. And here are the basics, right? You want to look at his takeaways. All right, there's a market cycle, now, much like Wychoff, I follow ICT, a lot of you guys know, he doesn't subscribe to Wychoff, but here's the important piece, right? Wychoff was a wildly successful trader, right? So I don't think it's wise for anybody to try to discredit somebody who was that successful. It'd be like me trying to discredit Warren Buffett. ICT is wildly successful. So both of these guys have methods and means that work, right? And it's backed by their financial gains. They both understand that there's a market cycle, right? This is very important as a trader. There's a market cycle. There's nothing that happens that's new. There's a cycle. If you pull up any chart, you're going to see a cycle. You're going to see the price starts here, it goes here, it comes back to here, right? That's a cycle. It has an accumulation, it goes up, it has a distribution, and it comes back down. Whatever you want to call that, whether you want to call it an accumulation, a reaccumulation, a distribution, whatever, right? It's a cycle. ICT, he has a different cycle, but it's a cycle. And once you understand that and you start seeing that, then your confidence grows, right? It's one of the reasons why retail concepts work on some levels as well, right? Because it's a cycle. That's why they say support and resistance, because the market starts here, it goes to the next level and it comes back, right? The the key takeaways to these, if you can, market structure is everything. And if you understand that when price breaks out, it's going to come back to retest and then either continue going or it'll fail the retest and come back. If you understand that as a trader, you are probably in the upper echelon of traders, right? You're going to win more trades than most people because you understand that simple concept. Now, how you put together rules around those concepts, that's going to take your trading to the next level. And if you choose to look at it from Wychoff's perspective, he was already wildly successful. So if you can implement his rules and start to gather an understanding of how he views it, then you'll be quite successful according to the way that he looks at the market. So according to his rules, a price trend doesn't ever repeat itself exactly, right? They have to be studied, but it's not going to be an exact repeat, right? And all that means is maybe it won't stop at the same spot. Maybe it'll stop a few pips, you know, or a few dollars at the same spot, right? It's going to go up and down, but the trend itself, you won't, like lightning never strikes twice in the same spot. That's kind of the way he looked at it, right? Also, if you look at a method, right? If you have a trading method, it helps you remain emotionless, right? It takes a lot of work for you to conquer yourself. You know, it's kind of like in a relationship. Maybe you're married, maybe you have a boyfriend, or maybe it's just your children, you know, where you have to go to counseling. You know, maybe you blow up on people, right? Or somebody triggers you. And, you know, a counselor will help you overcome those triggers, right? You know, we all laugh at Martin Lawrence on the Bad Boy series when he was Wusan, right? But sometimes you need to find things to take your emotions out of the situation so you can see a trade setup for what it really is, right? It's just a trade setup. Now, did you over leverage? All right, that's what, you know, over leveraging or too big of a position, or maybe you're stressed, you know, you have bills due. You can't trade. You can do it, but you know, it's not wise to trade if you need money, right? Because you're putting that pressure on the trade, right? You trade because you see the setup, not because you need the money. All right, you trade for the move, not the money. The money comes with every trade that you win, but you trade the setups you see, you know, based on your rules, and you take the emotions out of the trade. And you know, by doing that, you know, by trading a theory or a concept, right? It helps take the emotions, you know, out of the trade. Like, oh, if it goes up, this trade is going against me every time. No, your entry needs to change, right? It's going against you because your entry was bad. Your concept or the direction, your directional bias is probably good. You're in drawdown because it's a pullback. If you only trade 1%, don't worry. You know, that pullback is only going to cut so deep and then it'll go your direction. So, you know, whether you're trading ICT or Wychoff or some other trader, understand the concept and then place your rules around the concepts, right? So you can see his rules listed right here. I'm not going to read these rules to you because if you're interested in them, you know, I'm showing you how to come get them yourself, right? And I'm showing you how to come research what his market cycle was and his theory of the composite man, right? The composite man is there to shake you out of your position. Like, even if you're in a great position, they drop the market lower, right? Let's say you buy right here, you have a buy order and they keep pushing the market lower to get you out of the buy order. Next thing you know, the price is up here, and you got out because, oh man, the market's going against me. No, fool, it's not going against you. They just they're scaring you out of your good position. But if you have been patient, you'd have won all this money, right? All these pips. So it's important that you understand, if you're not over leveraged when you put your buy order in, your account can take this drawdown, right? If you take your emotions out, it won't bother you every time price goes up and comes down, goes up and comes down, right? Because you're not emotionally tied to the trade. What you are is you're understanding that your setup, your trade setup might take a little bit more time, and that we have an accumulation that's playing out in front of our face, right? So if you can recognize what's going on, maybe your patience for the move will improve, right? And you might even, once the price comes down here, might even add to your position at a better price. So let's talk about this. So smart money concepts, we talked about order blocks, imbalances, and Wychoff, right? What we really haven't talked about is what's actually going on. Like, what is it? Does everybody know what an institutional investor is? Drop a 1 in the chat if you don't understand what an institutional investor is. And it's not a big deal, but you know, it's important that you understand who we're talking about when we say institutional investors. Okay, so institutional investors is somebody who has a big endowment of funds to spend in the market. You know, whether it's trust fund people, you know, Morgan Stanley. Let's say there's a trader in charge of a Morgan Stanley account, or Charles Schwab, or any other institution, right? These guys they're fund managers, right? You guys heard of mutual funds and all that stuff. They're fund managers. They manage a portfolio, or they manage a certain amount of money, and what they have to do, they have to have a Series 7 license. They have to understand financial investments and all the risk involved, and they have to take this money and they have to invest it, right? Because rich people, or not even rich people, but some people just give them money. You know, how many of you have mutual funds? I know that was hot back in the day. I invested with Janus Fund, you know, way back in the day, which I just sent them a piece of my paycheck and they invested it for me. So, you know, if you figure you got all these millions of Americans and people sending their money to these people, they accumulate large sums of money. So Janus Fund Manager might invest your money, you know, in the Forex market or in the stock market or whatever. So an institutional investor is somebody who's in charge of somebody else's money, and they have a lot of money at their disposal, right? They don't have an MT4 app on their computer, right? They have a system that they place their orders in, and it goes directly to the market makers, right? So if you have a $20 million investment, you can't go on MT4 and pick a lot size to invest your $20 million. That's not how it works. What you do is you go to the fund manager and say, hey, you know, I have $20 million that I want to place a buy on Euro USD, but I want to buy, my buy price, you know, needs to be between, you know, $1.12 and $1.30, right? So you can't put a $20 million buy order in at $1.12 and think price is just going to stay at $1.12. You know, if that's the case, you know, you're sadly mistaken. So the fund manager will place those orders for you. So at, you know, maybe at the bottom of the order block, you'll get $3 million. The price goes up, right? Then some people will sell, and then you'll buy $3 more million, right? And the price goes up, and some people will sell, you know. Or you might have another fund manager while you're buying at $20 million, maybe they got in at $99. So they want to take some profit. So when you buy and it pushes the price up to $1.30, that's their trigger to get out, and they sell and the price comes back down. So they have to invest this money in increments. So that's what an institutional investor is, and that's what creates these order blocks. So when you have that understanding of people buying and selling and the areas that they're getting in and out of the market, now you can position yourself to buy and sell with those institutional investors. So let's go to the chart so we can talk about this for a minute. And we'll just look at one of these JPY pairs because they've been going crazy. Okay. So if you understand market structure, you got to break instruction, come back for the retest. The market pushes higher, right? Where it breaks this structure again, comes back for the retest. The market pushes higher, comes back for a retest. The market pushes higher, comes back for a retest. So what you're getting here is the market pushes up, profit taking. 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 And this is cyclical, right? Until you get to a point to where maybe 1, 2, 5, 10, 15 people take profit, or institutions take profit, and pushes the price way back down. Then they buy again, right? Now what you're seeing in the market is people getting out of the British pound, and the market is falling, right? They can't all get out at once, but they get out and they let us buy. Then they get out and they let us buy, right? Because why are you buying the British pound when you have all this craziness going on, right? When China's locked down, when the war is going on, right? When there's recession talk. If you understand your currencies, you'll understand that the Japanese yen is a safe haven currency, just like the CHF, just like the US dollar to a lesser extent. But the British pound is a risky currency, right? And you have that war pressure, and then you have the financial collapse in China, and then you have the lockdown in China. So that's why you see these prices pushing down. If you look at every JPY pair, they're all pushing down. So if you understand what's going on, you can better position yourself to take advantage of these happenings. And if you understand Wychoff, you understand that this market is going to push up temporarily, and you can drop down time levels. Every time you see the red candles form, you're going to see a distribution. It'll be a distribution schematic that plays out. And it won't be on the 4 hour. Maybe you need to drop down to the 15-minute or the 5-minute. And you can see as the market drops, you will see a schematic. Right? You got your up thrust, and you got to push down. Then the market comes back, right, to relative equal highs. Do y'all remember that? Or relative equal lows in this case. So if you drop down on a lower time frame, you'll see all they're doing is manipulating the highs here before they drop the market, right? So if you were in a sell right here, you were in good position, but they kept running the market higher, scared you out of your position. Then they dropped the market pretty quickly right here, bring it back to these relative equal lows right here to let you back in. This was your entry, and then you just sell it down. Does that make sense? So on a smaller time frame, what you will see right here is a break of structure. Then you get the retest, that green candle, and then you'll sell off. Break of structure, retest, sell off. That's a Wychoff schematic right here on the lower time frame. I'm not getting my directional bias from the schematic. I already have my directional bias from the higher time frame. And I understand that the Japanese yen is selling. I'm just waiting because I know that the market bought up temporarily. I'm waiting to get me an entry for it to sell off. Now, here's a bearish order block on the 5 minute. Could you have technically hopped in this trade? Yeah, you could have. The way I teach it, you want to get wicked in right here. But even my son jumps in here because he gambles, and he'd have taken this trade down. The point is, if you understand your schematic, then your entry would have been right here. Your drawdown would have been minimal. Look at that little wick, maybe. That's your drawdown. You're off to the races. So my point to you is, if you put time into this, right? If you put time into your trading, if you put concepts together and you put rules together, you'll be wildly successful. There's no way around that. Like, this doesn't happen overnight, but this will eventually happen for you. Your vision improves with the time that you spend on the charts, right? How many of you knew that the Japanese yen was a risk-on currency? How many of you guys know the difference? What is a risk-on, risk-off?
I think so. Like, AUD is a safe currency, and so when things are volatile, I guess that's the way I'm gonna say it. May not be saying it correctly. That's a pair that you want to trade, and it's the reverse for JPY.
So you say AUD is a safe currency?
Mm-hmm.
So you're saying that the Japanese yen is not?
I mean, I could be wrong. I'm sure you're finna show me I'm wrong because you're asking me that question. So that means I'm definitely wrong.
I want you to have an understanding, man. I'm not trying to make fun of you guys. I want you to understand what you're saying, right? And I want to gain an understanding of what you're thinking.
I guess the reason why I said, well, not guess, the reason why I said AUD is because even in the beginning, when I first started learning, when I first started learning, that was one of the pairs, I guess because of the way that it moves. So what I'm saying is probably not correct. So what I'm saying is, when you first started trading, one of the, you always look at AUD because it moves slower. So that doesn't mean it's a risk averse currency, but it's just the way that it moves. So
I think that, okay, this is the Japanese yen is your safe currency, right? The CHF is your safe currency. And the USD to the lesser extent, you look at Alicia, Google your friend, Alicia. But yeah, the USD to a lesser extent is a safe currency. And the reason the USD is a safe currency is because it's the reserve currency. It's the world's currency. But the Japanese yen is not a risky currency like the British pound. It's not going to be affected, you know, as roughly as those other currencies. So anytime there's uncertainty, like when they flew those planes into the trade center, you know, people take their money out of everything else and put it in the yen. When coronavirus hit, the yen. When the war hits, the yen. When China screws up with the real estate market, the yen. So anytime you see the yen getting stronger, especially when you see their economy is jacked up, you know, that should be your go-to, right? Like anytime you see some major threatening news, your go-to should be, hey man, sell those pairs that have the yen at the end of it, right? I'm gonna sell GJ every time something happens. GJ, you can GJ sell, right? If you see something major happening in the world, sell GJ, because that's what the banks are going to do. That's what the institutions are going to do, right? They're going to sell. They're going to sell something on the yen, right? They're going to sell something against the yen. Does that make sense?
Yes.
And I didn't find what I was looking for. Let me see, Google. No, risk on, risk off. All right, this is what I wanted to talk about. I mean, this is what I wanted to show you. So when we talk about risk on, risk off, right? It's it basically is speaking to the conditions when you have global economic patterns, recessions, wars, depressions. What did you say, Felicia? What's volatile? So basically, if there's something major that's going on out there that's striking fear in investors, you know, investors don't like uncertainty. They don't like surprises, right? If you have $20 billion or $20 million for that matter, if you have $20 million in that matter, you don't want to risk losing somebody else's money because the environment changed on you, right? So you go to something safe, right? You put your money in a currency that's not going to be affected by that extra or that added volatility. And the yen and the CHF, for the most part, are not going to be affected as you know, as much as like the euro or the British pound, right? I don't think the AUD is in there. Selena, I don't remember reading about the AUD, but it's no different in the United States here. Whenever things get dicey in the stock market, people stop investing in the companies, right? And they start investing in what? Savings bonds. You don't make a lot of money in savings bonds, but you don't lose it as fast as you can lose your money in a company that goes under, right? You understand that? So let's say a tech company or any Walmart or Target or whatever, those stock prices can go up or down, you know, at the drop of a hat. You know, if they get negative earnings, they might lose 5, 6, 7%, 10% of their value. A savings bond doesn't do that. Of course, you're not going to make, you know, 20, 30%, 40% from a savings bond like you can from a stock. But because the environment is less risky, then you'll take a little percent versus losing a lot of percent of somebody else's money. You guys understand that? So there's always what they have, what they say, a market sentiment, right? They call it a risk sentiment, market sentiment. Is how people feel about the investment environment. If you're a Dow Jones or a NASDAQ trader, they have a VIX, a volatility index, right? It's smart to have that in your favorites, you know, because you can understand that the market is going to be more volatile, right? And traditionally speaking, when the market is more volatile, there are certain things that people put their money into. So if you have that understanding, you can kind of position yourself in a way that you have an automatic trigger. You know, it's kind of like in Forex, you know. I've been following Evergrande for probably half a year now. Anytime there's Evergrande news, the yen turns around. Everything sells, right? It doesn't matter who raised interest rates. It doesn't matter. None of that stuff matters. When somebody talks about, you know, the Evergrande losing or defaulting on a $300 billion loan, the yen is going to get strong. So you sell everything. You sell NJ, EJ, GJ. You know, you don't even have to look at the charts pretty much. You know, they have a issue, you sell it. It's kind of like a trigger. And if you start doing that, if you start placing you know, emphasis on understanding why things are happening, or understanding that real world events trigger sell-offs in certain pairs, or they trigger strength in other pairs, then you'll understand what to look for, right? The price of oil, you know, will be $130 a barrel here pretty soon. Again, it'll be 130. The Canadian dollar should start increasing. Now, it's not as automatic as the yen. You know, it takes a little bit more time for that price change to happen, but you'll know it's coming because the price of oil heavily influences the Canadian dollar, right? Just the same way that, you know, when there's uncertainty or there's war or there's financial calamity, the yen is going to get stronger versus the other currencies. So if you read up on this stuff and you put this in your toolkit, then you'll understand how to position yourself better, or what to look for when you see these different things happening, you know, in the real world situation, and you see them playing out. So, you know, educate yourself on risk on and risk off environment, you know, because anytime there's a war, or anytime that there's a huge, you know, corona or whatever, like shutdowns and lockdowns, that stuff is going to affect how price moves in different currency pairs. And, you know, we went from everything going straight up, you know, in the yen, you know, to everything going straight down. You know, like even the US dollar started going straight down against the yen. That stuff, you know, you guys have to start taking notice, because it's going to repeat itself over and over and over. You know, 10 years from now, it's going to repeat itself over and over, because that's the way that things are, you know, in this environment, right? You guys have any questions over anything that we've talked about today? I know we're a little bit long, but I just wanted to kind of impress upon you that this is the beginning, right? And if you put a little time into it, you can develop your own ideas based off these concepts. And once you can develop your own ideas based off these concepts, you can set rules around that, and that will help you round out your trading plan, right? And then you can truly have a trading plan. You know, Ruby talked to us about trading plans. A lot of people talk about trading plans, but you know, to be honest, you know, if you don't even understand, you don't have concepts down. What do you? I mean, you can't really establish a trading plan. You don't know what your trading plan is because you don't have an idea of how to even develop one or what suits you. Maybe you have goals, but are they realistic? Is this market environment going to give you the same percentage that other market environments will give you? Do you even know how to go get your percentage? So all these things matter. I would just implore you to take your time and go through the information that we've started covering here. You know, next week we'll add on to the smart money concepts. We'll talk more, I guess, more conceptual things than we will